we started, I think.
Okay.
Yeah, I think we started. Yeah. Hello, everyone. Today I'm Alex and Rob Montgomery from Revest Finance. We'll talk about advanced DeFi topic, and there will be discussion about. Arya, please next slide. There will be discussion about convex, curve, and the Revest Finance tools for the DeFi. So there will be four chapters. Introduction, of course. So my name is Alex. I'm a founder of GTON Capital, which is Ethereum rollup, optimistic rollup, and we are utilizing decentralized stablecoin as its native currency. So basically it is. And of course, this rollup is designed not only for DeFi, also for NFTs and metaverse, etc. There are a lot of Web3 applications, but right now in this topic we'll talk more about DeFi. And Rob, please introduce yourself.
So, hey everyone, I'm Rob Montgomery. I am the CEO of Revest Finance. We make, so we built the Revest protocol, which is a general purpose engine for financial NFTs. And now we are building its first business to customer application, which we call Resonate.
Awesome, thank you so much. And on this stream we have Arya, who is the head of community of the GTON. Arya, please introduce yourself, and we'll go with the presentation. After,
okay, cool.
In the end of this presentation, there will be questions from community. The questions from the moderator we prepared. Arya.
Cool, thank you. Hello everyone, I'm Arya, GTON Capital's head of community, and today it seems like we are talking to the big bosses. Come on, please.
Yeah, thank you. Next slide, please. So let's start our academy topic. First of all, everything we said is NFA, and do your own research, because there is no financial advice. Everything you will find, don't buy. Next slide, please. It is important. I did everywhere. So NFA and do your own research. So
CYA.
Yeah. So first of all, what we're talking about today, the 2 years ago, there were explosion of DeFi protocols, right? So, and the most focus of those DeFi protocols been around liquidity mining and incentives. And, you have seen a lot of new projects with the more and more incentives on top on different liquidity mining approaches. But there are one important step missed, which is capital utility. Like what exactly you can do with the different assets, right? And the second one, efficiency. And today we're going to talk about both aspects, starting from the efficiency, and then on the case of Revest Finance, we will talk about capital utility, like what kind of cases we can do. So first of all, financial engineering is offering more optimal yield strategies. Of course, there is a lot of different strategies how we can maximize the capital, the digital capital we are using, and there are much more utility cases for assets. More than just trading, farming, or lending. So yeah, NFT plus DeFi is good, and NFT plus DeFi plus DAOs is even more good. Let's go. Next one. So yeah, a few months ago, we were talking about basic DeFi stories, right? About Curve, about IMMs, Yarn Finance, and let's recall what it is. The Curve basically is IMM pool where you can, hold your assets, for example, ETH versus stake ETH, and then you have something on top. You have farming rewards in the form of CRV token. Arya, please next slide. And the thing is, it is not only how it works. It's not like you providing some liquidity and then you farming some assets. Actually, there are new economy model for farming, which called V token or VCRV model. Basically, it means that if you are farming some assets, which is governance assets, so you can lock it somewhere and boost your reward in this asset. Right, it's pretty easy, and the idea is pretty easy here, because if you are earning some token, you are basically part of this ecosystem. You have to boost your rewards because you are basically a contributor into this ecosystem, right? So you have more rewards for what you are doing, but also you have governance power to change parameters of the protocol, or most often boost some pools if you prefer. So this is V tokenomics, or VCRV in our case. Let's go next, Arya. Yeah, so the VCRV in our case is just fancy name for locked CRV. You can actually boost rewards in more than 10 times, more than 2 times. Depends on how long you are locking your CRV token and how much you actually lock it. Next slide, please. So yeah, the simple chart, I will not go deep into that. It looks complicated, but it's actually pretty easy. If you are just providing liquidity, you are earning token. If you are providing liquidity, but your locked token, you are not selling, you are locking again, you are boosting your rewards. So, and also you have governance power. This is how most of the, ideas around how to boost efficiency of the capital you are using as liquidity working. Next slide, please. And here we have some interesting project which called Convex, and there was some hype like a few months ago. It was some hype around it, and the idea is pretty simple. They just a little,
just a little bit of hype, you know.
A little bit of hype, yeah. Of
Who's
course,
ever heard of this Convex thing?
Yeah. The hype started from the yarn actually, and the yarn suggested a pretty nice idea. Like, let's create one pool for anyone, and let's just sell on the half of rewards, and another half let's use as a boost. So this is how it started. But then we have Convex, which is much more flexible in that terms. They have more flexibility on how you can use boosted rewards. And but basically idea is pretty simple. They created the wrapper on top of Curve, where you can also provide some liquidity, like stake ETH or I don't know, Tether or different types of assets, right? And you can have, first of all, you can have more reward just because you are participating in the common pool for anyone. So the pool is already have boosted rewards. This is one thing. Another thing is they have additional token on top, which is increasing your income in that sense. So this is why if you're providing liquidity through Convex, you are basically boosting your liquidity. You are using your liquidity with a more capital efficiency, right? This is a topic about. Next slide, please. But it is not only about LPs. It is not only about providing liquidity in the form of liquid capital like Tether or USDC or Ethereum. It is also about how CRV can work for you to optimize the yield, right? So instead of using CRV to lock it as a VCRV, right? In the pool, you can actually provide your CRV for the Convex and get more and more revenues from the protocol. Next slide, please. No. Yeah, this is how it works. Previous one. This is how it works. You have your CRV, you deposit into the Convex, right? So, and you are basically boosting the APR for the pool itself, for the Convex itself, but also you have something on top of it, right? You have more revenue from the common pool, and in the form of CVX, which is Convex token. And next slide, please. And the CRV and CVX CRV is basically exchanged to each other, right? So you can lock your CRV in the form of Convex CRV and get much more because there is a combination of different factors, also including airdrops for the projects, or also including the fees which is generating by the common pool. So yeah, this is how it works. Basically, the wrapper with another token, which is boosting the general APR, and of course the most important thing is on the next slide. Probably you heard about Curve Wars and Convex Wars and bribing. So this is like, I think it's one of the most important thing, because all the talks in the different chats in different communities, they were around wars. They were around boosting some yields temporary or permanently for different hyped assets. And you can see the diagram here. You can see that Curve has pretty simple model. CRV, which is farming token, VCRV, which is boosting the rewards and letting you to vote around the profitability of different pools, right? And we have Convex, which is basically has its own token, looks similar, but also it's wrapping the CRV, right? And if you locked convex token into the governance, you can participate in so-called bribing. You can actually boost some pools to let them be more and more profitable. So, and everything around wars were around bribing. For example, Frax was one of the winner, right? The Frax stablecoin was one of the winner of this game, just because they managed how to actually properly bribe the APU for their pools. It were a lot of pools like Frax free pool and Frax UST. we still remember that, and more. Yeah.
Frax 3 curve that their main one is, right?
Yes. Yeah, and right now they have their own pool actually on top of it. So let's go next. This was convex. This was a topic about capital efficiency, right? Of course, it is a bit strange that the capital efficiency most often solving not by the algorithm itself, but introducing new token and some dynamics of how to operate with that. But this is honest truth that how crypto works. If you find some proper use case for another topic, for another token to somehow manage the APR, it can probably work. So this is how it works. Let's talk right now about utility and about reverse and resonate. First of all, we'll start with the reversed. Next slide, please. Yeah, the idea is pretty simple, right? We have convex like vaults or yarn like vaults where we have one vault for every depositors, and you can do something with that. But why do not working with that with a fractional manner, right? Why we can actually create the different vaults for the one asset, right, and manage it differently. So those assets will be in the form of NFTs, and this is how reverse finance is innovating here. Next one. Yeah, the idea is pretty simple. You have ERC20 token. You can split it on different parts, right? And for each part, you can have the NFTs with different parameters, right? It just sounds simple, but it has a lot of applications. Let's go next. Yeah.
Are we going to get into the extensibility here? Is that coming up?
What again?
The extensibility.
Yes.
Good. I'm gonna sit back.
So about reverse finance and the basic idea, the idea of functional FNFTs is pretty interesting because basically you are not working with the basic asset anymore. You can work with its locked version, right? And the unlocking terms can be different. And the next slide, please. Next slide. Yeah, so the lock-in terms or unlocking terms can be different. You can lock your assets with a time unlock, right? For example, after 1 week, months, or whatever. It is very interesting for vesting. For example, if you're gonna raise some funds and we have VC raise, so it's always connected with the vesting, right? So you can basically allocate some funds in the form of FNFTs with the different terms, like how those will be unlocked. But one of the most interesting thing is value lock, because basically you can not only design by the time lock, which is a standard vesting contract. You can actually design it as a value lock. Most often options works like that, right? For example, I'm a CEO of the company, and we agreed as a DAO, we agreed that if capitalization of the project will be skyline, so I will be rewarded somehow, right? How to program it? We can program it with the FNFTs. Basically, this is value lock FNFT, and let's imagine one example. We have one GTON, and we already have the governance vote about bonding activation for $5. So this is a case. Then the price reached $5. Something happened, right? In our case, the vault will be unlocked, and this is pretty important because basically you can do smart options on top of that. And another and also interesting thing is address lock. You can let only particular address to unlock something. Next slide, please. This is
I'm gonna jump in.
Yes,
because there is a special thing about the address locks. So Address locks can have two types of functionality for financial NFTs. First type is, yeah, you can tell Vitalik, hey, Vitalik, whenever you say this thing can unlock, it can unlock. And that's the push functionality. That's where Vitalik himself, he'd be triggering that unlock. Or, much better, this one opens up a realm of infinite possibility. That's where the address lock is a contract. And when the address lock is based on a contract, there's a standardized API that we provide called iAddressLock. Any contract that implements it can implement the isUnlockable function and say, hey, I don't want this lock to be unlockable until the following conditions are met. That allows for any parameter
Logic,
to be
right?
used. Yeah, exactly. You can say, I don't want this FNFT to unlock until the Braves win the World Series again. And you get yourself a good Chainlink oracle. Well, your lock will probably unlock sometime in the late 2020s if Atlanta sports has any pattern. But general idea is that those address locks, they can be anything.
So basically, because you can connect the smart contract logic for the address locks, you can, write any rule, right, on top of it.
Yeah, any
The basic
contract.
example can be on-chain governance, right? So you can create on-chain governance contract for some token holders to vote about can they do it or not.
Also, we
Also,
built proof of concept escrow systems through it.
Is it working already? Right? We can try. I mean, with the contracts also.
Yeah,
awesome.
we've got a lot of demo address locks out there. Our new system Resonate actually uses a production one.
Very nice, but we need audit for the contract, for the logic controller.
Yes, we have those.
Yeah, it's true. So another thing about FNFTs, they are NFTs. Means that you can trade them on OpenSea, you can transfer them, you can own them, you can do whatever you want. You can stake them if there will be application for NFT staking, right? Or you can lend them if you need. So yeah, this is pretty nice idea because it's basically creating new utility about for the assets you already have, right? Or for the assets which DAO have, and depends on the conditions. You can combine them. So next slide. We'll do faster. Basically, we have unlocked FNFT and we have locked NFT, right? So this is how it looks like. The next slide, please. Or we have unlockable, right? So it means that you can basically unlock it because it has different status. So it's easy. I really like the documentation with the visuals because visuals are really helping to understand the different states and different conditions for the FNFTs. Next slide, please. Yeah, and actually all the conditions can be combined together, right? And we have combo lock. So basically, the combination of different factors around where your assets can be unlocked. You have combo lock. Next please. And here I think I have some question. I also found you have NFT locker. Please, Rob, explain me the use case because I found the NFT here.
So the NFT locker, like I said, Revest is very extensible. And the way it works is it can lock tokens. It can also, however, act as a messaging relay to basically say, okay, this NFT is this financial instrument. That's how we can do VE curve locks. That's how we can do Resonate. And it can basically act as a signal sender to a position that's being held in a different contract. Once we realized this extensibility existed, we wanted to play around with it. And one of the first areas that we looked into was NFT airdrops. It turned out to not be that large of a market, but it did give us a lot of experience that we then took and turned into our VE curve system. However, what this actually is, and some of the math that we worked in designing this thing, and I probably should have also mentioned I am the lead Solidity developer for Revest as well as the CEO. Some of the math that we worked for the NFT locker system, it allows you to airdrop arbitrary tokens to an arbitrary NFT. So if I, as an NFT project owner, wanted to use this subsystem here, and we still offer it, it's a cool demonstration tech. It's had some minor usage. What you can do is you can lock up your NFT inside of an FNFT. And at that point, you've got a locked NFT that gets that off the, soaks up that liquidity, means that you aren't going to be able to sell, means that the NFT series has a less volatile floor, same as it does with it. And it means that you, as someone who wants to airdrop something in that NFT community, can do it with one click, rather than having to set up a Merkle route, rather than having to figure out, okay, am I going to batch send all these ERC20 tokens? No. You just go ahead and you say, these guys all get this many tokens, and we use the $1 billion algorithm and my own personal improvement of the $1 billion algorithm to allow for arbitrary tokens and arbitrary rewards to an arbitrary target. I'm quite proud of the math behind that, by the way.
But this is only works like one NFT and one token, or we can do several tokens at the same time, or we can do several tokens at the same time.
Several tokens at the same time for one NFT,
Interesting. So it can be some kind of partnership, like then you have 3 or 4 different partnerships around the NFTs. It's basically can be included into one NFT locker, right? Interesting.
I mean, it's a unique rewards distribution scheme. I don't know of any other like it, actually. And this particular tech, we know the NFT market is currently in a bit of a slump. So we launched this thing. It didn't find that good product market fit, but the tech that we developed to power it, it's incredible. And it's going to have a lot of other applications in our ecosystem, particularly when we start talking about Resonate.
Interesting. I think there are product market fits because we need more utility for NFTs in the first place. Like really, right now, only thing you can do is basically buying, selling, right? The few cases where you can actually accelerate or merge to different things like DeFi communities and the NFT communities in something, and this is basically solving this issue. I really like it. Next slide, please. As far as I understand, FNFTs let you fractionalize NFT as well, right?
To a point. We've mostly, basically, you set up a new NFT series. This tech has, the idea here is that you can go in and you can say, I've got one FNFT that's worth 100 tokens. And what I want to do is now, instead of having one FNFT that's worth 100 tokens, I want to have 10 FNFTs, each worth 10 tokens. So I can trigger a split operation and end up with those 10 different FNFTs. What I do is I burn the original FNFT, and then I create a new series that has 10. And that's the concept. That allows you to basically sub-split these things if you've got, if you've got a vested position, for instance, and you want to sell part of that position to a friend who wants to buy it from you because it's an OTC and he's not going to experience slippage, but you're stuck because you've only got, in units of 100 tokens. Fortunately, you can go back and fix that.
This case I really like because for expensive NFTs, this can be a case. I know about fractional NFTs. They have different models, like how you can basically change the NFT, the tokens back to the NFTs, right? And sometimes it's like, rule, like majority rule, 80%, 95%, whatever. If somebody lost more than 5%, in that case, basically, the NFT is non-redeemable, right? It belongs to community after that. So
no, we don't require any weirdness with the ERC20s.
Yeah, but what's the difference here? Like, how to avoid this issue as well?
Well, all we're doing is we're burning one NFT and creating a bunch of others. Because this is ERC 1155, you can have multiple copies of the same NFT within a series. So if you have one ERC 1155 that says it's worth 100 tokens, you can just split it up into 100 different ERC 1155s. They all cost the same amount to mint, and each one would be worth 1 token at that point. So the entire system is just based on how 1155 works. It's a very straightforward and simple concept. I
think
the low DeFi
have,
hangs up a lot of people though.
yeah, I think we'll have another topic around fractional NFTs and NFTs as well, because the combination of DeFi, NFTs, and everything, like we have two different types of like DeFi and NFT merging. We have a fractionalization, right? And we have party bidding. Party bidding is pretty boring because it's basically how people are organizing to buy NFTs, like the expensive ones. Fractionalization is much interesting because it's opening more ideas around liquidity provision, around different governance of ownership of NFTs, right? Like DAO ownership on NFTs. And FNFTs here has its impact. So I will probably in the future we'll go deeper in that. But right now, yeah.
Well, what I'm most interested in is getting this stuff set up on something like Pseudo. When you have individual curves for these ERC 1155s, which are in effect fractionalized NFTs.
Yes.
Talking about having one NFT that's worth one token, you have 100 copies of the exact same NFT. Having that set up on something like Pseudo Swap, where there's an AMM bonding curve, that's fascinating to me.
Yeah, the Pseudo Swap is another case with the IMM for NFTs. It seems like it's working out, right? It's like 20% of the volume of OpenSea, but at the same time, it's extra liquidity for NFTs. So it can basically accelerate the the hype killing of NFTs, because people right now, they can exit and pushing floor price down and down, and other people are
using it for exit liquidity, yeah.
Panicking, yeah. So it has its pros and cons, it's true, but in general, I think the more primitives we'll have, the more interesting concepts on top of that we can do. I think there will be everything around DeFi and NFTs will be part of different games in the future, because we need to use the different gears to create the complicated mechanism. Area, please, next slide, and this will be last topic of this educational part, and the last slide will be about Resonate. And Resonate sounds difficult, and next slide, please. If you try to read, you'll not understand. This is honest opinion from my side. Using Resonate DAO, DAOs can trade time for money, offering upfront payouts on yield in exchange for the rights to interest on locked and staked tokens. Actually, really hard to understand in the first reading, but let's go next.
That is good to know. I'll tell my communications director.
Next slide, please.
You shouldn't let CEOs write copy.
Yes, and the next slide. If you try to go deep into that, it's basically obvious. Like, imagine you have assets. In this case, ARVST asset, right? In our case, it can be GTON. So both assets, they have staking rewards. For example, different. Like in this case, it is like 30%. Means that you can, in the 6 months, 30% you can earn. So this is APR, right? For GTON, is different. It's 25 per year. But anyway, any assets, somehow they have their interest rates, right? You can basically earn something on top of it, and this is a future yield, right? This is a future profit, future cash in the form of the token you are staking, right? So, and the idea of Resonate is basically make it liquid, make the future yields liquid, make it future yields tradable. How it works? We know that we have 100 RVST token. In the future, there will be 130, right? Because this is how it works. This is how staking works. But what if you need money right now? And there is an opportunity for purchaser to buy those assets right now for the lower price, but you will still keep as a issuer, you will still keep your 100, right? But you will not receive the 30, because you're basically selling future profit, future yields. And this is how it works. You have match, you have purchaser, you have issuer. In the end, issuer is taking back its own 100 tokens, which is basically principal, right? And before that, he is basically getting 30 USDC. And the purchaser has an opportunity to buy in the beginning the future the future yield for the fixed price. Basically, it looks like a put option, right? Somehow.
On the yield.
Yes, but only on yield, not on the price, on yield, yes. But price and yield are basically the same in terms of valuation. If you are speaking about valuation terms, right, it's basically the same thing. So yeah, and this is how it works. And for the DAOs, it's interesting because it's allow you, as a DAO, it's allow you to sell the future staking rewards from the treasury for the cash right now, because you can reinvest cash in, I don't know, marketing activities or whatever to actually boost the capitalization. And for the purchaser is an opportunity to join the deal right now without waiting too long for.
So we typically think of the DAO as taking the purchaser role, because the DAO doesn't experience opportunity cost in the same way that a normal participant would. What they're doing is they're paying out, say, I pay you 30 tokens. Right? Okay, let's say I've got 30 tokens. As the purchaser, if I put those into the yield farm that's offering 50% returns over 6 months, then I'll end up with 45 at the end of 6 months. However, if I instead pay you those 30 tokens right now, I'll get 50 tokens because I'm purchasing the rights to your interest over 6 months. So I can achieve a marginal improvement on my return. As a DAO, normally I can't put my tokens into the yield farm because that would dilute it. But if instead of doing that, I bribe you to enter the farm on my behalf and get exposure to the yield, well, I paid out 30 tokens. I was paying out 50 tokens for my treasury and emissions every 6 months. But now, because I paid you up front 30 tokens, I get those 50 tokens back into my treasury. And what I've been able to do as the DAO is I've decreased my burn rate from 50 tokens every 6 months to 30 tokens every 6 months without actually lowering my APRs at all.
It sounds like magic. I'm always skeptical to listen that, but I think we need numbers diagrams as well as it is here, because the future yield, I understand it's easy to combine with the magic of DAO spending funds. It's a bit difficult to understand, to be honest.
Do you want me to get more into it?
What?
Do you want me to get more into it? I'm serious. I talk about this all day, every day, like probably 5 days a week at least.
But this is pretty interesting approach to actually. It's not about burning rate, right? It's about getting cash. It's like a loan. It's like a loan where you have interest in the form of your own currency, right?
It's not entirely dissimilar to Alchemix in some ways, but it's different. What it is you are accepting, as the issuer, you're locking up your principal in exchange for a guaranteed amount of upside. And you're giving up a portion of your upside to have that guarantee. So if I'm the issuer, I'm getting $30 right now, or maybe I'm just getting 30 revest tokens, but I've got that I can sell those tokens and I can have dollars. And so what I've done is I've shorted my own long, but without selling off a portion of my own long. That means that I've got that 100 token revest long that's locked for 6 months now in an FNFT. I can turn around and sell that on the secondary if I want, because it is an NFT. But I've got a 30% hedge as well against any market fluctuations. So if the market goes down 30%, I'm still fine. I got $30 cash. I can buy. Meanwhile, on the purchaser side, that guy, he's just getting exposure. He's getting additional exposure that he otherwise wouldn't have gotten. One of the charts, I don't know if you have it, we have a great example with Umami's vaults of why a purchaser would ever want to take this sort of a deal. Let me paint a picture for you. Umami offers 20% interest through their vault system, right? And 20% is incredible. They just got a deal with Circle the other day. And however, if I'm Circle, I want safe returns. I want guarantees. So I might want to get just 10% upfront, 10% returns on the dollar. And okay, if I get 10% returns on the dollar, I'm happy as an institution. I just lock up my USDC for a year. It's a CD, certificate deposit, same concept. I'm used to that. Meanwhile, somebody else, the guy who's paying me the $10 up front, that could be, say you, Alex, you pay Circle their $10 up front in exchange for locking their principal, and that principal is earning interest around 20%. So you pay $10 out up front, giving them that fixed rate of return, that 10% guarantee. You, if things go right, you get 20% returns on their principal, which is $20. So you paid out $10 and you got $20, and that is 100% return on USDC, which shouldn't be possible, but the math says it is.
Yeah, but what kind of risk you are facing here?
You're basically taking full exposure to the risk of the yield rate fluctuations.
Yeah.
That's
so
why you'd want to.
Zero, right?
Hmm?
It can be zero as well, if the yields are going down, right?
If the yield goes to zero, then you've lost. It's a bet. It's a very strong directional bet.
Yeah.
To achieve an ROI of 100%, yeah, you got to take some risk. You'll likely only get, I mean, that's why you pay out low. That's why you pay out pretty low. You pay out 10%, you get 20. Okay, if the real yield is only 15, you still won. You still got, 50% up from what you paid out. So you have to figure out where that comfort level is, where people will accept the amount you're paying them up front, but you're not totally cooked if the interest rates fall off a cliff.
Yeah, this is always about there is a curve, there is a special function of risk reward, right? And you have to find your own profile, like how you can risk, because like you are exchanging risk on the rewards. This is only thing how it works. There is no like free lunch, right, anywhere. And we need more protocols which are offering us the different place on this curve. The risk reward, and it's pretty nice. Area, this is your turn right now. We finished this part with the advanced DeFi and the utilities, and we have some questions from the community and prepared questions. Please.
Okay, nice take, guys. It is a really interesting topic and complex, actually, but I think it takes several streams to cover it all. But thank you both. I have some questions for both of you, and then I think we can get to the community questions. Okay, I'm checking. You have answered all of them, Alex. Thank you. And Rob. Okay, let's get straight to the community questions. I have highlighted some of them. The first one, why is reverse not on SudoSwap, Rob? Can you please?
So why are we not on SudoSwap yet? Because currently SudoSwap only supports ERC 721. I've been having some chats with Owen, encouraging him to adopt ERC 1155. He wants to adopt it, and we'll see where it goes. All things held equal, I could absolutely see us being on SudoSwap, and it is in fact one of my goals to have us on there. He's done really good work, he and his team. They've built something incredible.
Yeah, it's obvious that you love them and you want to be there. Okay, let's get straight to the next question. Are NFTs liquid? I check OpenSea and looks rare. There are many items there, but no listing.
So our biggest hit on marketplace volume has actually been on Phantom. That is where we've seen the most activity with FNFTs, and that is in a fairly specialized use case we didn't touch too much on, but it's definitely one of my favorites. We figured out VE, actually. Funny that Alex was talking about it. So we figured out how to take a VE curve position and place it within an FNFT. And normally VE curve positions, they're locked to your wallet. And yeah, that's great, but you can't sell them. They're stuck. What we were able to do is abstract that using a smart wallet, where the contract on chain acts as the wallet that deposits into the curve system. What that means is that you can then transfer that position. And we did this with these guys, Liquid Driver, on their VE curve fork. it's worked fantastic. There's around 30,000 phantom volume on those markets, and you're always going to see those things flying around. We also did it with their friends Spirit Swap, who have a very similar VE curve model, and it can be adapted to pretty much any VE system out there. So I would definitely check Phantom if you're looking to buy.
Cool, thank you. Thanks for the answer. Alex, do you have anything to add?
I'm actually exploring right now the reverse finance, and like to hear the answers.
Okay. One of our community members said that have you recovered from the March reentrancy attack, knowing fund DeFi Llama? Can you answer
Say again?
Have you recovered from the March reentrancy attack, knowing fund DeFi Llama? That is the question.
So yes, we have recovered from that attack. We've had 2 follow-up audits. We had an internal audit performed by a compliance expert who works at one of the major consulting groups. We redeployed several contracts to upharden the code, and all potential vulnerabilities have been patched. So we've had a Immunify bounty going for months now. I'm confident in saying the Lindy effect is in fairly full swing at this point. Those contracts are secure. And in terms of what we've been doing behind the scenes, people haven't seen what we've been up to. We've been really quiet for a few months now. So our business development has been in full swing. It's been incredible. We have been talking with some of the biggest players in the space. And I'm happy to say that in the very near future, people are going to be finding out an awful lot more about what we've been planning. We've kept everything under wraps very closely. If you knew exactly what to look for, you'd know who we've been talking to, but most people don't know what to look for. Our business developers are kind of sneaky.
That's great. I hope that you do well. Okay, Alex, there is a question that lots of our community members have asked, and that's about you. They say, when GTON network? When will we live?
Sir, when launch?
Then launch should be soon. We already finished the audits, and the results must be this week, I think. I mean, audits results, the end results, because the audit process is basically the iteration and iteration.
Mm-hmm.
So it must be soon. I asked my CTO.
Who did you guys end up going with? Pure curiosity.
Yeah. What?
Who did y'all end up going with?
Gone?
Audit-wise, who were your auditors?
We cannot disclose right now, like who is right now, because they have to finish. But previous ones was securing from Czech Republic, and they did pretty nice audit. They are not so popular, but they are, quite good comparing with others.
Yes. Hey,
yes.
Everyone out there, don't use Solidity Finance. If you're considering getting an audit, do not use Solidity Finance. Delic, BlockSec.
Yeah. The question how to choose the proper auditor is pretty difficult right now, because most often the auditors it's not the best one. So you have to do some proper research here. Next question, Arya.
Okay, great. Sorry about the light. We just had a power outage here. I'm sorry about that.
It's okay.
Let's get straight to the next question. It's related to both the projects. Reverse is a multi-chain protocol. Any plans to integrate GTON network into your platform? Rob and Alex, what do you think about it?
I could see it happening when the time is right. Absolutely. We go where the business is. That is.
You're going multi-chain, right? You're going multi-chain.
No, we are multi-chain. Reverse itself is an inherently, it works on any EVM. It is multi-chain agnostic. The token's only on Ethereum right now. That may change someday. But the protocol itself can be launched anywhere. Same with Resonate. It's all EVM agnostic. As long as it's running the EVM, it can run Revest. It can run.
I found some interesting question area right now in the live stream. Can GTON Capital use FNFT with the time logs for a week or a quarter for bonding functionality? And as far as I understand, we can use it for the bonding functionality, right? Because basically the FNFT with the time logs are bonds, and and we can add more extra rules on top of that. For example, the what the value of the token must be for the unlock. So there will be more sophisticated bonds actually. I have no idea about Olympus. Have they tried the more sophisticated bonds on top of Revest? Rob?
We've
Also?
talked with Olympus about various things, but I don't think so. No, that they're currently building their own types of bonds, but you could definitely use Revest for it. It would be very easy. It works out of the box. You wouldn't need to do any. You wouldn't need to do a lot of your own work. Put it that way.
Yeah. Also, is it something like, speaking about bonds functionality? What's the reason for Olympus to build their own implementation of bonding? Like, what the pros cons? You don't know?
I mean, in terms of just them wanting to keep things in house, I think that's their main, their main, what's the word, motivator. In terms of actual, just ease of access, there's no reason not to use Revest. It's literally just a functionality we have out of the box. Integration is something we've already seen people attempt in an Olympus bonding model. Our friends over at Exodia, unfortunately, no longer a DeFi protocol that exists. Thank you, Bear. But they were working on that before they unfortunately disbanded. So people have tried it, and the code is out there to actually implement it. So, hey, if Apollo or Zeus are listening, I can point you toward the repo. Hit me up.
Area, you have more questions? I think we have some issue. I have interesting question in the live chat right now, actually. Like, why do you feel trading derivative NFTs can be as attractive as trading classical speculative assets?
So why do I feel trading derivative NFTs can be as attractive as trading classical what assets?
Classical speculative assets. I don't know what it is. It's like, I think futures or something, right?
So I would say that there are some assets that don't make sense as the ERC20s. That's the answer that I would give, especially when you're talking about something like yield separation or options or any kind of a realistic future. If you try to do that through an ERC20 series, you run into some serious problems, as people who've tried to do the separation of principal and future interest have discovered. Namely, you run into the issues of 1, valuation, and 2, liquidity. So when we talk about other folks who have attempted what we're doing with Resonate, for instance, you see people like Element, AP Wine, Pendle, Swivel, all these guys who tried similar stuff in the past. What happens is you are using an ERC20 series. You are setting, hey, this date right here, this day is the maturity for all of them. Okay, several problems. First off, once that day hits, everything unlocks at once. And that's actually a pretty big problem for whatever the token is, because it leads to dumps. But less practical, more theoretical. Now you're trying to value these assets on a moving timescale. They're positive theta assets typically, especially if you're talking about the principal. The interest might be positive or negative theta depending on where the uncertainty is lying. But you have to use something called the Black-Scholes equation to do that. The Black-Scholes equation is a highly complex, I mean, yeah, you know what I'm talking about, Alex. It's a partial differential equation. Yes, it's not easy. It doesn't make any sense in crypto. So what ends up happening is you're trying to value these assets, and their value is changing day by day by day by day because they are approaching maturity at that fixed velocity. So that means that you now need a special type of AMM that can account for that without creating massive and permanent loss in your liquidity providers. Your liquidity providers have to switch their LPs every 6 months. You're trying to value this thing with a function that you probably dreamed up as an analytical function, which is not going to work as well as just letting the free hand of the market decide. And yeah, you run into this liquidity fragmentation problem, you run into this valuation problem, and stuff doesn't really work as well with the ERC20s. However, if you do these as NFTs, where you can have that commerce at the moment of creation of the instrument, and then the maturity is a fixed term, for instance, 6 months, well, then the free hand of the market can figure out very easily what the going rate of those things is, because it's not trying to do so on a sliding time scale day to day. That is Resonate's core innovation, actually, is the realization that it makes a lot more sense to do this with NFTs, because they can have different maturity dates than it does with the ERC20 series, because all ERC20s on a contract will inherently have the same maturity date. I hope that's a good enough answer, and I hope that made sense.
We'll do shorts, YouTube shorts, so people can see it again. I think
just pull up a picture of the Black-Scholes equation. They'll understand.
Yeah, you missed the half of the people on the Black-Scholes equation. Yeah, it's true. But
Oh,
basically, it's pretty simple one. Then I did financial engineering lessons. My teacher was focused on examples. You know, like he didn't start it even from the full equation. He just started from the margin cases on different angles, and then I just realized, okay, I got it. You know, like it's easy as it should be, actually. So we have a question from Amir Hossein Hadimi. Do RFST rewards overlap the possible drops in price of the collateral in the vault, and where do they come from?
So RVST, the system there, it doesn't reflect any of the backing of the vault. Revest as a token is a revenue share governance token, and you lock it into an FNFT, you get voting rights, you get revenue share from the revenue produced in fees by the protocol. Not all that different than Curve, actually, in many regards. But its main purpose is it just circulates. It allows you to do that. It doesn't have any ongoing reward streams beyond the fees, which are in ETH. So that token is, to be completely honest, it's not sexy. It's not, you know, crazy high frills, ridiculous tokenomics, but it does exactly what it's meant to do.
But it's simple. I check it. It is simple. Like, you have protocol revenue. This is how it works. I think most of the protocols must work like that, because otherwise it's, you know, magic. If you don't know where the yields are coming from, probably it's you, right?
Yep, exactly. We went with a very straightforward, this is where the yields are coming from. It's fees.
Yes.
Resonate's about to drop a massive amount of those into Revest.
You know, it's like, it's boring, but it's honest work, right? It's
exactly.
It's boring, but it's transparent.
It's real finance.
Yeah. Ariel, have you found some interesting question as well?
Yeah, I get disconnected for a minute. I don't know if you answered this question or not. I found a very interesting one. What are the obstacles for the NFT lending as a new DeFi market? The entire TVL right now doesn't exceed $18 million, whereas the whole lending market is around 17 billion. How to foster this area?
NFT lending is going to get a lot more interesting once financial NFTs really get into the mix. Myself, I'd say we're at the forefront of that. I would say the guys at Velodrome, cool guys. They've also contributed to that with their solidly fork. I would say Uniswap V3 is the only other big one that I know of that's playing around with FNFT tech. And with that, you're going to see that market start to mature and get a lot more powerful as FNFTs enter the lending market. How do you value those? You really need to have a way to standardize what's inside them and understand, okay, this is the value that's locked inside. This is the time to maturity. Let's apply some sort of approximation, or just allow the free market to decide what their worth is, because there's always a discount when you have a locked asset. That's the positive theta I was talking about earlier. So for NFT lending to really make sense, you're going to need to see protocols that are focused on these FNFTs that have this inherent value, rather than just speculative artwork. I think as we see that getting more and more common, where the protocols themselves have valuation mechanics for FNFTs built into them on a wide variety of FNFTs, myself, UniV3, Velodrome, I think you're going to see something along the lines of, adapters being built to measure stuff, much in the same way that 4626 has got adapters now and a standard for measuring value in bolts. You're going to see that applied to FNFTs, and the lending market just kind of grow out from there.
Cool, thanks, Rob. I really think the same about the NFT lending, and I hope that we see more from both your project and all the other projects that are building for NFTs. Actually, I have no more questions. I want you to, if you have anything to add for a conclusion, feel free to add, please. Go on, Alex, please.
Let me also answer about NFT lending. I think this is how it will evolve, actually, because lending is letting you to hold assets but give extra liquidity, right? It's basically solving the capital efficiency issue, because you're still owning the asset, but you can do something because another assets, they have another liquidity. So you are opening the opportunity for liquidity. So here we need more cases with the NFT lending markets. The only issue is, and we discussed that on the previous stream a week ago with the earlier, that the NFT pricing is shit. So because you don't know how to price it properly. The floor is vanity metrics, because for non-liquid you can pump floor as far as you want. For liquid assets, floor has more sense, but still it's very, very volatile, very unpredictable in terms, even in the short term and long term. It's really difficult to understand. Protocols like SudoSwap somehow solving this issue, because they are introducing like IMM style of trading, right? So the price discovery is a bit easier here, but still right now the blue chips are not going into SudoSwap. I think the reason is because it is basically killing the hype because exit liquidity for most of the members. Small projects, they can probably push it back, but yeah, we need pricing we need some models for pricing, and this is crucial. FNFTs is a good example of how we can wrap different combination of tokens and NFTs, but it is not solving, unfortunately, it's not solving the pricing issue. It has to be somehow addressed. It has to be somehow solved. Here I have one question to Rob. Speaking about value lock, you mentioned that there are two different opportunities for value lock, right? You can lock based on channeling price fit, right? For example, if the price is reaching some levels, but also you mentioned that it is possible to work with the time weighted average, like TWAP, right, from the Uniswap. And I also noticed in documentation volume weighted average. Can you explain the difference here? Like why you think volume weighting is much better here?
So volume weighting is a totally different formula. And for that, we have an external partner, our friends over at the Unification Foundation, who have an oracle designed to offer VWAM pricing. What VWAM is it's a way of using volume to, how do I put this? With a TWAM, what you're doing is you're averaging the price over a period of time, right? You're looking at like a 24-hour period and you're calculating the average across that 24 hours. But if I push the price up really high using and there's just not a lot of volume, I push the price up really high over that 24 hours and it stays up really high. And then finally somebody corrects it with an RBOT or something. And it comes back down to normal where the real trading is going on. And all of the real trading is at that volume because it's come back to its normal price. Yeah. There's a bunch more volume at a lower price, but for a long amount of time, it was at a really high price. Well, when I calculate the TWAM, I'm going to get an unrealistically high price because there wasn't a lot of volume there wasn't a lot of time that it spent at the realistic price, even though that's where most of the trading is occurring. So what a VWAM is it would say, look at that same time window and it would say, okay, all the volume is here in this much smaller time scale, but there's a lot more volume in that area. So when it calculates the average, it uses volume weighting to figure out, okay, the price is actually a lot lower on average because there's so much more volume at that lower portion. It's a much more manipulation resistant method.
Yeah, but at the same time, I think I know some way to manipulate. Because if it's on the dexes, I can actually wash trade, right? And on the certain price, I can wash trade, boost the volume weights, and then somehow manipulate. I think there will be some kind of aggregation of prices, like, you know, if you'll combine the approaches like chain linked, TWAP, and volume weighted, and you know, you will able for the volts to use the aggregation function on top of that. It will be much robust, and basically the vault owner, right, or vault creator will able to create it.
So what I found is, yeah, in general, you want to go with something along the lines of Chainlink. You do run the problem with value locks that, yeah, market makers exist, and they want to hit that strike price, especially if you directly incentivize them to hit that strike price.
Yes.
So yeah, that is an angle that's very difficult to control for, just because of the way that these markets work. If you have multiple liquidity pools, you can make it a little bit harder, because now you have to have these guys targeting both liquidity pools to prevent their own value being stolen by arbitrage bots. But it's an interesting problem. In terms of the NFT pricing question, I almost wonder, and I'm just going to throw this out there because you hit on a really interesting point with pseudo, and I want to jump back to it. Could we use pseudo as an oracle? Not raw, because using that raw, that's really someone's going to come up with an NFT flash loans next thing you know, and it's going to be ruined. But would pseudo be a good oracle? I could see there being arbitrage opportunities for NFTs having their prices too high on OpenSea, bringing them over to pseudo, selling them, at least if they're bottom, if they're floor NFTs. So would that work?
I think in the beginning it should, because you have no other choice anyway for NFTs. It's like this is the best choice. This is what it's actually the single choice to do proper pricing, because floor price on marketplaces it's doesn't work actually. Different marketplaces suggest a different floor, right? And there are a lot of outliers and in all of them, in all of the NFTs. So yeah, unfortunately we are running out of time, and sorry area for this last question. I think it was interesting and important for the whole community. No worries at all. I have nothing to add here. I just wanna say that we'll try to organize the GTON Academy more often. So we are highlighting some topics. This is part 1 of advanced DeFi. The part 2 probably will be around leverage tradings, leverage farming, etc. And this will be announced soon. Thank you, Rob, for being guest, for answering the questions. Thank you, Arya, for moderation. Thank you, guys.
Much appreciated.
Mainnet soon. Sorry. GTON mainnet soon. Bye, guys.
Y'all take care. Bye.